Hello, dear CA final students. Our ICA has released this booklet on case scenarios having 140 plus pages. So it's very important that you should go through all these case scenarios before exam. Here, what I'm going to do is from today, every day I'll be doing 5 case scenarios. Let's study together. Let's do it together. So let's move on to case scenario number 1. I am not discussing the provisions. I assume it is already done by you. Let's revise all the questions. So this case scenario is from Ind AS 115, sale with right to return. Very easy. A Limited is engaged in the business of manufacturing a number of products including molds, dyes and machinery. They have a wide customer base both within India and abroad. Typically, a contract is entered into for a sale of each product and consideration is received on the event of delivery of goods. The cost is 400 and sale price is 450. The terms of the contract entitle the customer to return any unused molds within 30 days and receive full refund. The company estimates the cost of recovering the mold will be immaterial and expects that the returned molds can be resold at a profit. A similar type of illustration is there in our material. Company has sold a total 10,000 molds during the year ended 31st March 24. From the past experience, A Limited expects 3% of the molds will be returned during the current year. So we are selling 10,000 molds, selling price 450, and we do expect 3% of the molds will be returned. The consideration received from the customer is, of course, it is variable because there is a refund liability attached to it. Upon transfer of control of 10,000 molds, the entity will recognize the revenue for 10,000 minus 3%, 9,700 molds. The entity recognizes revenue of 9,700 into 450, that is 43,65,000. The entity recognizes a refund liability of 300 into 450. 300 into 450, how much? Will recognize a refund liability of 1,35,000. The entity recognizes a return asset of 300 into 400, that is 1,20,000. Journal entry will be trade receivables debit because 10,000 into 450. Revenue 9,700 into 450, 300 into 450. So case study scenario 1 is done. Now, case study scenario number 2. All Limited holds 35% of total equity shares of M Limited, an associate company. Okay, All Limited is the investor and M Limited is the All Limited is the investor and M Limited is the investee associate. The value of investments is 300 lakhs in CFS. All Limited sold goods worth 3,50,000 to M. Okay, investors sold to M Limited. Investors sold to M Limited. Cost of goods sold is, so investors sold to M Limited. Cost of goods sold is 3 lakhs. Out of this goods costing 1 lakh to M. Goods costing 1 lakh to M were in closing stock of M Limited. M Limited declared and paid a dividend of 75 lakhs to the equity shareholders of the company. During the year ended 31st March 24, P&L of M Associates P&L showed a profits of 150 lakhs. Okay. What is the share of Old Limited in the post-acquisition profit of M Limited? What is the share of Old Limited in the post-acquisition profit of M Limited? So it must be 150 lakhs into, what is the share? 35%. 150 lakhs into 35%, 52 lakh 50,000. Compute unrealized gain on unsold inventory of Old Limited. Unrealized gain is 50,000 is the profit added on a sales of 3,50,000. Why do I calculate on sale? So that I can find out how much on 1 lakh. So it's given 1 lakh cost. It's 1 lakh cost to M. So that 1 lakh represents cost plus profit. So I am finding out 50,000 divided by 3,50,000, 14.29%. on 1 lakh, 14,285 into 35%. Into 35%, 4,999. We'll take it as 5,000. What is the share of old limited in the dividend declared? Dividend declared is 75 lakhs. Of course, 75 lakhs into 35%. 26 lakh, 25,000. What is the value of investment as per equity method? So it is 300 lakhs plus we added a share of 52 lakh 50,000. There is an unrealized gain of 5,000 which we need to eliminate, and 26 lakh 25,000 dividend declared also should be deducted. So it is 352 lakh 50,000 minus 5,000 minus 26 lakh 25,000. It is 33 crore 26 lakh 20,000. 3 crore 26 lakh 20,000 equity method. What is the appropriate gross margin? 14.29%. That is 50,000 divided by 3 lakh 50,000. Okay. Yes. So 52 lakh 50, 5,000, 26 lakh 25,000. Okay, all correct. Now question number 3. Case study scenario number 3. A Limited is a diversified business group operating in multiple business segments across different parts of the world. It maintains its books of accounts and publishes its annual financial statements under Ind AS. The finance team has been working on closing the books of accounts and generating financial statements for the financial year ended 31st March 2012 and are facing the issues in the following transactions. You need to focus only on the transactions given. A Limited on 250 ordinary shares in X Limited, an unquoted company. X Limited has total share capital of 5,000 shares with nominal value of rupees 10. X Limited's after-tax maintainable profits is 70,000. Oh, this is from Ind AS 113. An appropriate price-earning ratio from published industry is 15. A Limited's management estimates that the discount for the lack of marketability of X Limited shares and restrictions on the transfer is 20%. A Limited values its holding in X Limited based on earnings. So their profits is 70,000. Price earning ratio is 15. So 70,000 divided by 5,000 is the EPS 14. 14 into 15. 210 should be the value per share. Minus, there is a 20% discount. So minus 20%, 168 is the value per share into 250. 42,000 is the total value of shares, fair value of shares. Okay. A Limited has a telecom segment. It entered into an agreement with B Limited, which is engaged in the generation and supply of power. The agreement provided that A Limited will provide 1 lakh minutes to talk time to the employees of B Limited in exchange for getting power equivalent to 20,000 units. This is from which area? Ind AS 115 non-cash consideration. A Limited normally charges 0.5 per minute and B Limited charges 2.5 per unit. So what is the question? Let's find out from the MCQ. A Limited began construction of a new building at an estimated cost of 7 lakhs on 1st April. To finance the construction of the building, it obtained a specific loan of 2 lakhs from a financial institution at an interest rate of 9% per annum. And it has two non-specific loans, outstanding non-specific loans, general borrowing Ind AS 23. Expenditure incurred is also given. So that is from Ind AS 23. Now what are the questions? What is the value of shares of X Limited? So value per share is 168. So they are asking all the shares into 5,000, 8,40,000. What is the fair value of A Limited's investments? 42,000. By what amount revenue to be measured and recognized by A Limited? So what is the rule? In days 115, what is the rule? A Limited will provide 1 lakh minutes of talk time and will get 20,000 units power equivalent. See, listen, as per Ind AS 115, in case of non-cash consideration, revenue is recognized at the fair value of goods and services received. So which means 20,000 into per unit 2.5, 50,000, right? 20,000 into 2.5, 50,000 is the revenue to be recognized. 50,000. What will be the capitalization rate for computation of borrowing cost on the building based on general borrowings? On general borrowings, what will be the capitalization rate? 7 lakh into 12 percentage plus 9 lakhs into 11 percentage divided by 16 lakhs. So it is 7 lakhs into 12 percentage and 11.4375 percentage. 11.4375%. What is the amount of borrowing cost on specific borrowing? On specific borrowing, there is a specific borrowings of 2 lakhs. Date of loan is maybe from the beginning, 1st April till uh, till what is the date of, oh yeah, so it is 2 lakhs into 9 percentage into 10 by 12, 15,000. 15,000. What will be the total amount of borrowing cost on general borrowings? On general borrowings, so here 1 lakh 50 specific out of 2 lakhs, also 50,000 specific. So balance 1 lakh 50,000 into 11.4375 percentage into August. August first, let's assume August, September, October, November, December, January 6 by 12. Because we can capitalize borrowing cost only during the construction period. So again, 3,50,000 into 11.4375 percentage into October, November, December, January 4 by 12. Then 1 lakh into 11.4375 percentage into just 1 by 12. So it is coming to 22,875. Oh, sorry, option, yeah, 22,875. Okay. Now, case study scenario number 4. Yeah. Case study scenario number 4. H Limited is a globally diversified business conglomerate with operating spanning multiple business segments across various regions worldwide. For maintaining its financial records, the company follows Indian accounting standards. Ind AS. As the finance team diligently finalizes the books of accounts and prepares financial statements for the financial year ending 31st March, it requires insights and accounting suggestions on the following transactions. H Limited holds 12% of voting shares in Z Limited. Z Limited's board comprises of 8 members and 2 of these members are appointed by H. So 2 by 8. So H in Z is only 12%. But Z's board of directors are there are 8 members of which 2. So 1 by 4 voting power is with H Limited. Each board member has 1 vote in the meeting. So here we say if we have done in AS 24, we can say Z Limited is the associate of H. Let's find out what the question is. And there is significant influence. H Limited holds 10% of voting power of G Limited. The balance 90% voting power is held by 9 other investors, each holding 10%. The decisions about relevant activities except decision about taking borrowings of G Limited are taken by members holding majority of the voting power. The decisions about borrowings are required to be taken by unanimous consent of all the investors. Further, decisions about borrowings are not the decisions that most significantly affect the returns of G Limited. Okay. H Limited is also engaged in the business of pharmaceuticals. It has invested in the share capital of Y Limited and is holding 15% of Y Limited's total voting power. Y Limited is engaged in the business of producing packing materials for pharmaceutical entities. One of the incentives for H Limited to invest in Y Limited was the fact that Y Limited is engaged in the business of producing packing materials, which is also useful for H Limited. Since last many years, 90% of output of Y Limited is procured by H Limited. What is the relationship between Z and H? Z is associate. What is the relationship between G with H? Okay, what is the relationship of G Limited with H Limited? Of course, not subsidiary. But there is no joint venture. How can I say there is no relationship? Because there is only 10% voting power. But the decisions about borrowings are required to be taken unanimous consent by all the investors. If unanimous consent is required by all the investors, then it is joint arrangement. But that is not the decisions that most significantly affect the returns of G Limited. So there is no joint arrangement, not subsidiary, but only 10% share is there. So we conclude that G Limited is an associate of H Limited by considering substance over form. These type of questions are given in Ind AS 28, not in 24. Ind AS 28, where they are telling how can you justify there is significant influence. If there is a small video of mine which I can share in the description box where I'm discussing all these areas. Okay, in detail. Now, what is the relationship of Y limited with H limited? Relationship of Y with H, there is dependency. 90% of output procured by output of Y limited is procured by H limited, but there is only 15% share. So that not subsidiary, but you can conclude it as an associate. Okay. So here Z is an associate. The significant influence. G is an associate and Y is also an associate. Now, case scenario number 5. Joy Limited wishes to calculate tax base of its assets and deferred tax as on 31st March 25. The balance sheet has been adjusted by current tax expense. Extracts of assets part of the balance sheet is as follows. PPE 12 lakhs, intangible assets, product development cost 60,000, investment in subsidiary 4 lakh 40, trade receivables, investments, inventories, cash. What are the information given? Depreciation expense for the year 14-15. Allowable in accordance with tax losses 2 lakh 6,000. Accounting depreciation included in operating cost is 1 lakh 70. Cost of PP is 16 lakhs and Joy Limited has deducted expense of 4 lakh 16,000 in its tax returns prior to the financial year 14-15. Moreover, as on 31st March 15, Joy Limited for the first time revalued its property, plant and equipment to fair value of 12 lakhs. So what is given? How much is PP? 12 lakhs. What is the tax base? So carrying value is 12 lakhs. And what is the tax base? Cost was 16 lakhs. Already 4 lakh 16,000 is deducted and 2 lakh 6,000 is deducted. So 16 lakhs minus 4 lakh 16,000 minus 2 lakh 6,000, 9 lakh 78,000 is the tax base. Okay. Now, 9 lakh 78,000 minus 12 lakhs. We create a DTL on this 2 lakh 22,000. 9 lakh 2 lakh 22,000. Let's find out what the question is. With respect to point A, determine tax base 9 lakh 78,000. With respect to point A, determine deferred tax on PPE. Deferred tax rate is given as 32%. So 2 lakh 22,000 into 32%. DTL 71,040. With respect to point B, we have not read. In 11-12, Joy Limited incurred product development cost of 1 lakh. These costs were recognized as an asset and being amortized over a useful period of 10 years. For tax purpose, Joy Limited deducted full product development cost in 11-12. So what is the current year? 14, 15 is the current year. So already 1 lakh, 11, 12, 12, 13, 13, 14, 14, 15, 40,000. Carrying value will be 60,000. Tax base is nil. So we need to create a DTL of 60,000 into 32%. Tax base is nil. Tax base is nil. Determine deferred tax. DTL 19. Next. Trade investments were acquired in 13-14 with a cost of 2,30,000. These investments are classified as FVT P&L and thus recognized at their fair value. The fair value adjustments are not tax deductible. So cost of 2,30,000. Okay, fine. With respect to point C, what is the tax base of trade investments? 2,30,000. With respect to point C, determine deferred tax on trade investments. Or deferred tax. Yeah, they have given here trade investments 2,08,000. 2,08,000. 2,30,000 is the cost tax base. Carrying value is 2,08,000. Carrying value is less. So it is 22,000. 7,040. 7,040 DTA. What is the net DTA or DTL? So it is PP, DTL, product development cost, DTL. So taxable, deductible. So deferred tax liability, net deferred tax is 83,200. So 83,200 net. I hope this was beneficial. I have not discussed the provisions. We are just quickly going through the case studies. See you tomorrow with the next video from case study scenario 6 to 10.